Welcome back to Legal Watch, and today this is a Tax Watch special. I'm Walpole Lassiter, attorney and athlete agent, and today we are talking about one of the least glamorous and most dangerous parts of the NIL economy. Not the headline deal, not the flashy endorsement, not the social media clout, but the tax shadow hanging over all of it. Because the truth is simple. A lot of athletes, families, creators, and even some representatives are still treating NIL money like it exists in a side pocket outside of the real law. They talk about it like it's bonus money, free money, casual money, scholarship adjacent money, and the IRS does not care about any of those fairy tales. The IRS generally treats NIL income as taxable income. In many cases, the student athlete is treated as an independent contractor, which means the athlete is not just an athlete anymore. The athlete is also a business, a record keeper, a filer, and sometimes a very surprised future defendant in a tax mess they did not see coming. And once you add agents, collectives, payment apps, barter compensation, multi state appearances, and international athletes into that stew, you get a beautiful legal casserole of confusion. Legal casserole of confusion. So today I want to do three things. First, I want to explain what NIL income actually looks like through a tax law lens. Second, I want to explain the legal traps, especially constructive receipt, hidden agent fraud, non cash compensation, and multi state exposure. And third, I want to walk through the real defenses: contract drafting, documentation, penalty protection, theft loss analysis, and strategic cleanup if prior year income was missed. Because in this space, tax compliance is not just compliance, it is asset protection, brand protection, and in some cases, career protection.
You're listening to the AAA Ball and Play podcast. Quick note, this is for education and entertainment. Nothing here is legal, tax, or financial advice, and nothing we say creates an athlete-agent relationship. Listening or contacting us does not make us your lawyers or your agents. For advice, talk to a qualified professional in your state.
The NIL era changed more than compensation. It changed the legal identity of the athlete. Before NIL, the average athlete's economic life was comparatively narrow. Scholarship issues, cost of attendance issues, maybe a Pell Grant question, some work study or summer employment. But NIL introduced private contracting, revenue generation, licensing, promotional services, royalties, gifts tied to deliverables, and a genuine small business reality. The IRS now specifically addresses NIL income for student athletes. Its guidance explains that NIL income is taxable and that student athletes are generally considered independent contractors for tax purposes. The IRS also explains that self employment income is typically reported on Schedule C, while royalties and certain other income may go on Schedule E. That classification question matters immediately because not every NIL dollar is taxed in exactly the same way. And this is where I want athletes and families to kind of slow down for a second. A paid autograph session is not the same thing as a royalty stream from licensed merchandise. A sponsored post with deliverables is not the same thing as passive licensing. A free car lease in exchange for appearances is not the same thing as a W 2 job. And if your advisor treats all of those categories as one mushy blob called NIL money, that's how people end up with bad returns, bad records, and very bad surprises. The IRS also makes it clear that if the athlete has $400 or more in self employment income, self employment tax rules can kick in. And if the athlete expects to owe at least $1,000 in tax for the year after withholding and credits, estimated payments are going to be required. So this is not optional, grown up cosplay. This is the actual tax system. So the first legal lesson is this: NIL did not merely create earning opportunities, it created tax obligations attached to business activity. The athlete who understands that early has a huge advantage over the athlete who treats every deal like casino winnings with better lighting. The first myth is if no form shows up, I'm fine. And let's just kill that first monster, okay? If a 1099 shows up, if no 1099 shows up, there is no tax problem, and that is absolutely not true. Taxability does not depend on whether somebody sent you a tax form. A 1099 is an information reporting tool. It helps the IRS match data. It is not the thing that creates the income. Now, the reporting thresholds matter, and people have gotten sloppy about this because the rules have changed and been delayed and reworked and generally strutted around like a confused peacock. But here is the current point that matters. For payments made after 2025, IRS guidance says the general threshold for Form 1099 NEC and certain Form 1099 miscellaneous reporting is $2,000. And for Form 1099K issued by third party settlement organizations, the federal reporting threshold reverts to over 20,000 and more than 200 transactions, though some entities may still issue a form below that level. So, no, 2026 is not some universal $600 Form 1099K apocalypse. That part of the earlier public confusion needs to be put in a box and carried out of the room. But here is the trap athletes hear that and think, great, then I'm under the radar. No, you may be under a reporting threshold and still owe tax. You may receive no form and still owe tax. You may have multiple small payments and still owe tax. You may receive goods, services, or perks instead of cash, and guess what? You still owe tax. And on the NCAA side, that is a separate compliance issue entirely. Current NCAA CSC guidelines say that certain third party NIL deals of $600 or more must be reported in NIL Go for Division One compliance purposes. That reporting system is not the IRS. It is a sports governance disclosure mechanism. Different rule book, different consequences. Do not confuse a compliance threshold with a federal income tax rule. That distinction matters so much because athletes can get hit from two directions at once: eligibility, compliance problems on one side, and tax problems on the other. So now let's get to the doctrine that makes agent fraud and delayed payments especially dangerous. This is called constructive receipt. Publication 525 states that income received by an agent for you is income you constructively received in the year the agent received it. It also says that if by contract a third party receives income for you, that amount is generally included in your income when the third party receives it, not you. This is an absolute menace in the NIL space. I want you to picture it like this: a brand agrees to pay an athlete $50,000 in December for a campaign. The brand pays the athlete's agent or agency in December. The athlete does not actually see the money until January. Or worse, the athlete never sees the full money because the agent siphons part of it off. From a tax perspective, the athlete may already have income for that earlier year because the agent received it on the athlete's behalf. This is a huge deal because now the athlete may face one, tax liability on the gross amount, two, a cash flow problem because the money is not actually in hand, and three, a dispute against the intermediary. That is why I keep saying agent fraud is not just a contract problem, it is often a tax problem wearing a contract costume. And this doctrine also wrecks a lot of creative dodges. Sending the money to a parent first, a relative first, a business manager first, a creditor first, or some other favored middleman will not usually shift the underlying income away from the athlete who actually earned it. Assignment of income is not some magic wand. Tax law has seen that movie before and it did not enjoy it. So for athletes, constructive receipt creates one major strategic commandment: never let your representation structure become a blind tunnel. If payments are flowing through an agency, management company, a collective, a marketing representative, the athlete should have immediate visibility into invoice amounts, payment dates, payment sources, deductions, commission calculations, remittance dates, and year end reconciliation. Because once the money is received on your behalf, the tax consequences may already be in motion, whether you got the cash or not. So the next trap is non cash compensation. Athletes tend to recognize cash as income. They are much less likely to recognize value as income. Now, the IRS says barter income and the fair market value of goods or services received can be taxable. In business context, that value generally has to be included in gross income. So let's translate that into real NIL life. If you receive a vehicle lease, free designer clothes, free airfare and hotel, a paid training package, videography and production services, a gym membership, luxury lodging, or other compensation in exchange for promotion or endorsement activity, that may still be taxable. The phrase, they didn't pay me money, is not a defense. It is often just the opening sentence of a tax bill. And then we get into valuation. Fair market value becomes the battlefield. What was the actual value of the benefit? Was it personal? Was it business? Was some portion deductible? Was there any documentation? Was the athlete using the item exclusively for NIL activity? Was the travel tied to a bona fide promotional obligation? That is where record keeping becomes the difference between a defendable position with the IRS and a shrug. If a car is partly business use and partly personal use, the athlete needs logs. If a trip was for content appearances and filming, the athlete needs contracts, schedules, emails, and evidence of deliverables. If apparel was compensation, the athlete needs records of what was received and when and why. The tax law phrase here is ordinary and necessary business expenses. But that phrase only helps you if you can prove what happened. Otherwise, it becomes one of those beautiful legal phrases people love to say right before losing. Now let's talk about agent fraud more directly. The dirty trick in a lot of athlete representation disputes is not always obvious theft. Sometimes it is structural concealment. Maybe the athlete is told the brand paid $20,000 when the gross contract was really $35,000. Maybe production fees were quietly deducted. Maybe travel, consulting, admin, or campaign strategy charges appeared out of nowhere. Maybe commission is taken on reimbursements that should not be commissionable. Maybe the athlete never sees the actual invoice or the actual brand email or the actual payment confirmation. And because of constructive receipt, the athlete may still face tax exposure tied to the real gross amount that came in. That is why the contract is the first tax defense document, even though most people just treat it as an economic document. A proper representation agreement should include clear commission language, gross versus net definitions, timing of remittance, mandatory accounting statements, the athlete's rights to inspect records, conflict of interest disclosures, limits on affiliated vendors, and immediate termination rights for non payment or concealment. Legally, this also matters because agency relationships are fiduciary in nature. When a true principal agent or where a true principal agent relationship exists. Fiduciary duties involve loyalty, care, good faith, and the obligation not to secretly profit at the principal's expense. That gives athletes more than just a you breach paragraph 7 argument. It gives them a broader theory of wrongful conduct where facts support it. Now, can you draft around some duties? Sure, parties can draft a lot of ugly things, but a contract that tries to blur accountability, erase transparency, and let the representative operate in the dark should be treated like a snake wearing cufflinks. This is especially true for younger athletes. They are often signing under pressure with asymmetrical knowledge and with a family structure that is emotionally invested, but not always professionally equipped to audit what is happening. So the legal defense here is proactive. Draft tightly, document constantly, and never let trust substitute for verifiable accounting. Because the IRS is not going to excuse underreporting just because the athlete says, my guy handled it. Now let's talk about one of the most important developments for victims of agent fraud and certain scams, Section 165, theft loss treatment. For several years, many people assumed theft loss deductions were basically dead outside disaster situations because the TCJA sharply limited personal casualty and theft losses. And TCJA is the Tax Cut and Job Act. But IRS Chief Counsel Memorandum 202511015 clarified something important. Theft losses incurred in a transaction entered into for profit may still be deductible under IRC 165C2. IRS Publication 547 and the instructions for Form 4684 now reflect that point as well. So, what does that mean? That matters tremendously for athletes. Why? Because retaining an agent Entering an endorsement deal or participating in a monetization arrangement is generally a profit motivated transaction. So, if an athlete's agent steals NIL proceeds or an investment slash endorsement agreement arrangement with a profit objective turns out to involve criminal theft, the athlete may have a real argument that the loss falls under the still available profit transaction side of Section 165. Now, let me be careful here because tax law loves conditions. This is not automatic. The athlete still needs to establish things like there was an illegal taking under applicable law, that the transaction was entered into for profit, that the loss was discovered in the tax year claimed, and that there were no reasonable prospect and that there was no reasonable prospect of recovery to the extent of the deduction. That last piece matters a lot. If there is still a realistic recovery path through litigation, insurance, settlement, or another source, timing becomes complicated. So, what does that mean in practice? It means the tax lawyer and the civil lawyer need to be speaking to each other. It means the athlete needs to preserve bank records, contracts, payment confirmations, communications with brands, agency accounting, demand letters, police reports, even if appropriate, and any litigation filings. Because in the right case, the tax return is not just where you report the loss, it is where you begin to stabilize the damage. And just to clear out one more little gremlin, there is no general 95% or 75% deduction rule for ordinary agent theft cases. Those percentage concepts show up in very specific scam or safe harbor contexts. They are not the universal formula for every athlete who got robbed. Now, let's suppose the return is wrong. Maybe income was omitted. Maybe classification was sloppy. Maybe records were incomplete. Is the athlete automatically dead in the water on penalties? Well, not necessarily. The regulations say reasonable cause and good faith are determined case by case, considering all the facts and circumstances, including the taxpayer's knowledge, experience, and education. That is especially important in the NIL world, where many taxpayers are very young and commercially inexperienced. This is where professional reliance matters. The athlete who hired a competent CPA or tax lawyer, turned over complete information, disclosed the real payment flows, and actually followed professional advice has a much stronger penalty defense story than the athlete who guessed, winged it, relied on social media tax hacks, or kept half the transactions off the books. And that leads to another useful tool, which is Form 8275. Now, the IRS says Form 8275 is used to disclose items or positions not otherwise adequately disclosed on the return in order to avoid certain penalties, assuming there is a reasonable basis for the treatment. Now, that does not make every bad position safe. It does not recuse nonsense. But for close questions, it can be an important shield. This is the grown up version of tax strategy, not can I hide it, but how do I disclose and defend it properly? Because disclosure is often cheaper than false bravado. And in 2026, the IRS is also continuing to warn taxpayers about bad tax advice on social media and impersonation scams. That matters in this ecosystem because athletes and creators live online, and the same channels that sell them endorsement opportunities can sell them tax garbage. Now let's widen the lens. A lot of NIL activity is not local anymore. An athlete may live in one state, attend school in another, film content in a third, sign autographs in a fourth, and travel constantly. The IRS NIL guidance specifically warns athletes to keep track of where they perform NIL services because state and local tax obligations may arise where the income is earned. That means an athlete doing appearances, camps, shoots, or sponsored content in multiple states may need multiple state filings depending on those state rules. This is one place where terrible record keeping becomes extremely expensive very quickly. And for international athletes, the problem doubles. The IRS says non resident alien athletes performing independent personal services in the US generally owe US tax on US source income, including endorsements and related income, and withholding rules can require 30% withholding absent applicable relief. The IRS also explains that a central withholding agreement may sometimes reduce withholding based on net income, but tax law is only half the issue. USCIS says F1 students generally may not work off campus during the first academic year, except within authorized pathways, and immigration authorities treat unauthorized employment as a failure to maintain status. So, an international athlete can have a deal that is taxable and potentially problematic from an immigration standpoint at the same time. That is why these athletes need coordinated tax and immigration advice, not just somebody saying, everybody's doing NIL now, you're probably fine. Probably fine is not doctrine, it is a prelude to paperwork. Now let's talk cleanup. Sometimes athletes discover prior year problems late. Maybe the agent concealed money. Maybe a parent managed account was sloppy. Maybe barter income was ignored. Or maybe multiple small payments never got tracked. Or maybe the athlete just genuinely did not understand any of this. So, what then? The first point is this: do not panic and do not freelance a solution. The second point: not every missed income case belongs in the IRS voluntary disclosure practice. The IRS states that the VDP is for taxpayers making a truthful, timely, and complete disclosure of willful noncompliance. That is a criminal practice lane, not the default path for every negligent or innocent NIL reporting mess. So, counsel has to assess the facts. Was the omission willful? Was it negligent? Was there bad advice? Was there agent concealment? Were records falsified? Has the IRS already contacted the taxpayer? What years are involved? What forms were filed or not filed? In many athlete cases, the right answer may be ordinary civil correction, amended returns, substantiation development, and a penalty defense strategy. In some more serious cases, a deeper voluntary disclosure analysis may be warranted, but nobody should lunge into VDP like it's a customer service counter. It is not. And whether the path is amendment, disclosure, or litigation support, the athlete needs a reconstruction file with every deal, every invoice, every bank statement, every app payment, every email, every gift, every travel record, every deliverable, every intermediary, because the first job in cleanup is not argument, it is reconstruction. Here is the real takeaway. The NIL era created freedom, but it also created paperwork, tax exposure, and new avenues for exploitation. The athlete who thinks only about signing the deal is thinking one move too short. The athlete who thinks about classification, timing, constructive receipt, agent's transparency, non cash compensation, state sourcing, international withholding, documentation, and penalty protection, well, that athlete is protecting the actual value of the brand. Because the IRS shadow gets darker when the records are weak, when the contract is sloppy, and when the representative controls the money without accountability. That shadow, but how on the flip side, that shadow gets a lot smaller when the athlete has a clean paper trail, a competent tax professional, tight agency documents, good disclosure practices, and a legal strategy for fraud before fraud ever happens. That is what financial sovereignty looks like in the NIL era. It is not just getting paid, it is keeping what you earned, defending what was taken, and making sure your tax return does not become the quiet place where your career starts bleeding value. This has been Legal Watch, a Tax Watch special. I'm Lee Walpole Lassiter. This is legal information and general tax information, not legal or tax advice for any specific person or situation. Get real counsel before making any real decisions.
You're listening to the AAA Ball and Play podcast. Quick note, this is for education and entertainment. Nothing here is legal, tax, or financial advice, and nothing we say creates an athlete-agent relationship. Listening or contacting us does not make us your lawyers or your agents. For advice, talk to a qualified professional in your state.